Thanks for staying with us on SABC News. So Asian stocks sank on Thursday, extending global equity declines after new signs of sustained inflationary pressure in the US boosted the case for elevated interest rates for longer. China trade data released on Thursday, while not as dire as economists had predicted, still showed a nearly 9% slide in exports and a more than 7% drop for imports. The People's Bank of China continued its bid to shore up the yuan by again setting strong official midpoints for the currency. Now, despite those efforts, the yuan continues to hover on the weaker side of the closely watched 7.3 per dollar level in offshore trading, and it sank to the lowest since early November in the middle of last month, undercut by a rapidly deteriorating property sector and the risk of a spillover into broader markets. So Hong Kong's Hang Seng and an index of mainland Chinese blue chips each dropped around 1.3%, while Japan's Nikkei fell 0.5%. Let's go to Wall Street then. Over in the United States, Wall Street's three major averages closed lower on Wednesday. The Nasdaq led declines after stronger than expected services sector data fueled concerns that still sticky inflation would mean that interest rates stay higher for longer. So the S&P 500 lost around 0.69%. The Nasdaq Composite lost 1.05%, and the Dow Jones Industrial Average fell 0.58%. Let's come a little bit closer to home. The JSE is trading lower today. The all-share index has declined by 0.9% to 73,750. The industrial 25 index is 0.7% down. Financials have shed 0.4%. Markets in Europe are firmer at this hour. Britain's FTSE 100 as well as Germany's DAX have added 0.3%, and the CAC 40 in France is 0.6% higher. When we look at commodities, gold's trading at $1,920 an ounce, platinum at $903 an ounce, and a barrel of Brent crude oil still above that $90 level at $90.18. The rand is trading around 19 rand and 22 cents to the dollar, 23 rand and 94 cents to the pound sterling, and 20 rand and 58 cents to the euro. Makwe Masilela from Makwe Fund Managers joins us now. Makwe, a very good afternoon to you. Let's start with those inflationary pressures in the US and energy prices said to be contributing to global market jitters.
Yes, because the minute you start seeing that happening, it means Reserve Bank or central bankers, they just have to continue increasing interest rates or maybe maintain those interest rates higher for longer. And we know the negative impact when it comes to high interest rates versus equities. And we know that's not going to bode well, even for the general economies. And remember, markets have been thinking that probably we might get a soft landing. But remember, at some point, we were too worried that with these high interest rates, the rapid increases in interest rates will probably lead economies to fall into a recession. So all those concerns get to be reignited.
All right, so earlier on I spoke about the export data out of China, not as bad as people had expected, but they're still concerned that there's not enough stimulus massaging the world's second largest economy and something else needs to happen there.
Definitely. I mean, it's drips and drops there. And we know they've been focusing mainly on their property sector, which makes sense because it accounts for almost 30% of the economy. But the markets have been used to sort of a bazooka when it comes to stimulus, when we talk about China. And I think we're disappointed, since they are reopening in December, that they have not lived to the expectation. So maybe at some point the guys will start doing something much better. Yes, it's still a drop, but at a slower pace.
All right, so speaking of data, in Germany, industrial numbers out today, those were quite weak. What does that speak to, and what else is happening in Europe?
It makes us worry. Remember, Germany is not only the largest economy in Europe, but it's also the biggest driver when it comes to their growth. And we know that now most probably they might slip into a recession. And so far, it's not only this data. So far, the series of data that has been released has not been good. And if Germany gets to slip into a recession, then that pulls down the Eurozone, all of it.
Okay, so let's come closer to home. We saw Sanlam coming out with very impressive figures and then a SENS announcement by Capitec about their board. Both their share prices down, though. Take me through that.
Starting with Sanlam, we've seen that the guys have a very strong performance, and all because they had a favorable claims experience when it comes to the life insurance, also benefiting from the equities performance, as we know that they take up premiums and invest it into the markets. And also they've seen a rebound when it comes to the general insurance, not forgetting forgetting the credit business that has done well in India. But now we've seen something which is worrisome, or maybe it's a confirmation of reality, that there have been some significant increase when it comes to cash outflows, especially when it comes to service products in South Africa. That itself is a reflection that the SA consumer is struggling, and a nice volume growth when it comes to new business, but also that includes that ABSA management business, and the gas profits as headline earnings per share up a whopping 118%. And with Capitec, it's more of a diversity when it comes to their board, and these are independent non-executive, because it's critical to have a significant number of independent directors on your board, and the guys are coming with experience from financial services to ICT, stuff like that. So hopefully that bodes well for Capitec going forward.
Okay, and so we've been speaking about the price of Brent crude oil above $90 a barrel here in South Africa. Why does it matter to us? Why should we care about that price?
That's inflationary, because now we're going to be paying more, and the minute we see something being inflationary, it tells you that the Reserve Bank don't have any reason to stop or to pause when it comes to interest rate hikes, or let alone to think that we might start seeing any decrease when it comes to interest rates. And should that happen, we know that high inflation is a monster itself, because it makes the value of your money to be less. And so far we've seen salaries not growing at that rate of inflation, and as we know, if interest rates continue to go up, it means we'll be left with less money to spend on other things in the economy. And we know that our economy is more than 60% driven by consumer demand, so that will impact the economic growth going forward.
All right, Makwe Maserela, the Chief Investment Officer from Makwe Fund Managers, thank you so much for your time and analysis on SABC News this afternoon. Appreciate it. All right, it's time for a short break. When we come back, we'll keep on speaking about Raymond Ackerman and his legacy, and just look at his business and bring you some more business news, consumer confidence news as well. Do stay with us on SABC News.